Okay, what do we got here? This all looks good. It's just working. What's this, day number 6? We just get the audio right now. I'm not jinxing it or anything, but we just know what we're doing. Hey, welcome to the closing beat, everybody. Happy Wednesday. How you doing out there? Now the audio's not going to work, right? Why is it gray? Why do I look old, man? We're financial advisors here at Jazz Wealth. I'm actually 40. I'm 40 years old. You know what I mean? I own it. I like it. I'm fine with that. We talk about the stock market here most of the time. We're financial advisors, of course. And so the reason we do this daily, by the way, it's marketing. But the reason that I like doing it is we're pointing out what you should be seeing happening in your mutual funds, your 401ks and things. So we're not necessarily saying like day trade this, buy this, sell that. It's fun. I know a lot of you do that. But the goal is to say, wow, if energy was really strong, but tech was really weak, what does that mean? Will I go look at my 401k, my IRA, Roth, whatever, and find weakness? Will I find strength? So I just like the education part of it. So it fits people that are long-term investors, short-term, and all that good stuff. I like short-term trading as well, but we're focused on the long-term here. Also, last week's Wine and Wealth, I should say the upcoming Wine and Wealth is going to be focused on the retirees. That'll be tomorrow, actually. So we're going to be talking about the things you got to do, right? What should be a checklist type item? And I'm not talking general junk either. I'm talking about specifically, what do you need to do when you decide you're about to pull that trigger to retire? So for our clients, that'll be there. Also, last week, really cool visual. It's one simple visual I put in our notes from Jazz to show market performance leading from beginning prior to a recession, like 250 days, going all the way through. I averaged and medianed out every single one of those recessions there so you could see what happens. It's basically the same thing every time. It's kind of fascinating. And then Fin Tips, our videos that we do on YouTube every day. We're focused on retirees, right, in the month of August, so that in September we can spend our time with clients doing all of that and getting real geeky and stuff. So I'm happy to be a part of that, and Eric will be a part of it as well. You guys are not interested in that probably too much because it's a big day, right? Not only a big day for the stock market, you could see it on the right-hand side of your screen, but a big day for maybe the Fed to do a little victory lap, right? What they're doing is clearly working, except for Tampa. Cody told me that in Tampa, we're the only city, major metropolitan area, to have still double-digit inflation. Yay. That's where we're at anyways. But so other than that, inflation actually peaked. Now, if you go look, if you're a research member or you're one of our clients, go to Notes from Jazz 2 weeks ago. And I actually laid it out to show how inflation has peaked and why it will peak, and then why core CPI or core inflation numbers will have peaked as well. So I just walked you through that just to show. It's not like it was pretty easy to spot this time, but I like to show ahead of time instead of say, oh, I told you so. You know what I mean? If I can show you ahead of time, then you're able to see that there. Let's take a look. Where are we at here? Here's your consumer price index. This is the year-over-year number. This is the headline number that you will see. We have now pulled back to 8.52. We were expecting 8.7, which still would have been a pullback. That's down from 9.1. That's where we last left off there. There it goes. And so it kind of shows that, hey, maybe we've peaked here. At least in the short term, it looks like we've peaked, and looks like that's the end of that one. So okay, that's all you get. We've peaked there in CPI, so that's good. Now, looking at the probability of the next Fed rate hike, major changes over there in the betting odds, which are actual futures trades that are happening, not just people guessing or surveys. So yesterday, there was a 32% chance of having a half-point rate hike, which would be less than the last two. They did 0.75. Today, that number is 58%. So big increase there. That's a pretty sizable shift if you follow this on a day-to-day basis. For a 0.75% rate hike, yesterday was at 68%. Now it's at 41%. So all that happened is people said, we don't need 0.75. We're going to go towards 0.5 or 50 basis points there. So quite an interesting shift there in what the belief is the Fed will do. Maybe just a half-point rate hike. There is still plenty of time for them to change their mind or for data to come out that explains otherwise. PCE is the expectations, and that's really what the Fed likes to use. It's just, for whatever reason, we've all been focused on CPI, and so that's the good news today. What does that all mean? If you look at the charts here, what it means is the Fed likely slows down the way that they're raising rates. They've been just on a mission lately, right? So they likely slow that down, which means growth stocks, tech stocks, interest rate sensitive stocks, they all get a chance to breathe a little bit after being sort of demolished there. So you see the S&P higher today. You're going to notice the NASDAQ much stronger there. You're going to notice that if you look at the Dow, that's not as sensitive, but come on, there you go. The Dow also moving higher. The Russell 2000 not as affected, but still nice to have that sunshine on the economy, the U.S. economy anyways, to help the small caps out there. And so you get a pop basically across the board. If I turn my attention to the S&P here, there's a couple other things going on as well. We have over 90% of all S&P companies have now reported earnings. Really, retail is left. Retail goes at the end. If you weren't familiar, banks go first, retail go last, if you're not familiar with that. 75% of all S&P companies have beat on earnings. It's good. It's not great. The average is 77%, so we're trending right around there at the 5-year average. So, you know, not too bad there. So far, earnings growth is set to hit the target of 6.7% for the quarter. Again, that's not bad either. It is the lowest number since during COVID. So it's not great, but it's nothing to sound alarms or anything. It's just kind of a steady number there. If you're one of those fundamental geeks out there, welcome. The S&P is now trading about 17.5, over 17.5 times forward earnings. But I would point out, if you like to look at forward earnings, that analysts as a whole have lowered earnings expectations for the next 6 quarters. So forward earnings estimates are a little bit skewed. There's obviously time for that to change, but if you look at that and say, well, the market's technically cheap relative to forward earnings, well, where'd we get forward earnings numbers? They lowered them all, right? We get them from analysts, and they've all lowered those numbers there. So we'll see. I don't know. That'll be fun to talk about as the earnings seasons go on here and here. But I want to point that out because I got that a couple times. People say, isn't the stock market cheap on a forward basis? Yes, but it's by design, or it's because of about, 48 people. So you got the NASDAQ. Here we go. So the NASDAQ, it's going to be did it do it? That is, I believe, well, this is the NASDAQ futures. I believe that's a bull market. Oh, so close. Technically, you got 2 points to go. Okay. Well, no, more than that. So technically, you would have 6 points to go, but this is a new bull market for the NASDAQ, right? You're going to see someone want to call that if you haven't already. Large cap growth stocks were the ones that popped today, and you know why. I just told you, right? The Fed maybe slows down the rate hikes that allows those companies that really need to borrow money and send out or to offer debt in exchange for them to keep growing. Maybe they could do it at a reasonable cost, and they have a projection of what that cost will be. And remember, people say this all the time. Growth stocks get hit with a higher interest rate environment. No, not the case. Growth stocks get hit in a rapidly increasing interest rate environment. If we can stabilize, we can project growth will slow for these big growth tech stocks and things like that, but they can project the cost to borrow. Right now, they can't project, right? Because we're just, the Fed's like 75 basis points. So that's really all that is. Don't let that, I see them get that wrong on TV sometimes where someone will be a guest and they say, well, these tech stocks are going to suffer because rates are high. No, it's because how fast they're going up, not because they're high. The market has lived through much higher interest rates than where it's at now, and tech stocks have done fine. Anyways, I got off on a tangent there. Yeah. Okay, every sector in the green here today. That is true. That is true, actually. And 8 of the 11 sectors did, in fact, gain over 1%. Your leaders, consumer discretionary, doesn't look like it, but that's one of your leaders here today. And it tied with tech and materials, right? So there you go. You got the XLK. You could use any ETF you like. I like showing these are the most popular there. Materials as well. One fun thing I did. Did I do this for you? There you go. Ta-da. All right, so using our research site, what I did is I said, well, hey, tech is up double digits. There's a couple sectors that are up double digits in the last month. Is that odd, right? So I took tech. I used the XLK. It's a little cut off because I'm squishing it to show it on the screen here. But in the research site, I said, okay, XLK gaining more than 10% in a 1 month period, any 1 month period. It could be a rolling 1 month. It does not have to be a calendar month because that's 1 month from today is not a calendar month. We look back 20 years. We see that the XLK has had a return of more than 10% over a 1 month period 174 times over the last 20 years. And I should warn you that this is including every rolling period. So there's two ways to calculate it. We chose to do it this way. You could do it either way. You're going to find the same positive symbols or same results, but it's actually going to show more occurrences, right? So obviously, just how you want to calculate it. So forward performance going forward. Average performance is a 2.78%, 2.74 median, positive 70% of the time. What I want you to see is in the middle of the screen here, we plot what happened before, right? I always find that fascinating. Great, we gained 10%, but did we just fall a whole bunch and we're recovering, or is that actual growth? So previous window, again, these are rolling by the day here. So we've got double-digit losses, not too bad in here, some single-digit gains in there. And as you keep going, you see more and more losses. And I didn't do a forward lookup, I'm sorry, but in other words, what you see is the double-digit gains in tech tend to come after large pullbacks, right? Which is why you have to be in. Right? So if you looked at tech and said, I'm a tech investor, and then this year you got crushed a little bit, you can't run away because the gains are coming back quick. They come back quick, and I'm talking about 1 month time period, but the gains come back quickly in tech. And it's just because of volatility. So tech is more volatile. You see, it's like riding a Bronco. So if you're going to invest in tech, or you have tech mutual funds, tech growth funds, large cap growth funds, whatever it may be, you got to expect that volatility. When times are bad, you got to look away, because right around the corner, times get good really quick, and you can't guess that was the bottom in the market and it was going to blast off. So the moral of that story is the data shows when you have really double-digit pullbacks or strong pullbacks in the market, it leads up to a strong bounce. Even if that bounce peters out and not much happens, you've got to be a part of that, because how many of you right now are saying, if the market only falls back to that prior low, I'm in? Really? Is that really the truth? If we fell that fast and we gave up all that, you think you'd be excited? I don't think you'd be excited. Because if what happened before, if this scared you, there's no way a quick move back to lows, just because of chaos or something, there's no way you're getting back in. So, moral of the story, when you have big declines, you can't run away. You can buy into it, but don't run away, because you miss out on these little rocket ships that take off. And it's important to be a part of that over the long term. We're rambling today. Commodities, oil up a little bit today, 1.1%. You're not expecting oil to just blast off out of nowhere. We have now passed the seasonal period of strength going into soon to be going into the fall and the winter months. So it's not normal for oil to just blast off. You also have, as far as gas goes, you have the gas tax, whatever it is, 15 cents. So that's helping visually, but not really. You got gold basically flat on the day, and it's done, right? It's had its great move. It needs to digest this area here. It's a minor resistance area. We've covered that in the past. And so that's what you have there. Taking a look outside the old stock market here real quick. I'm going to pop over here. This is from Realtor.com. This is not my data, so when it is not, I try to post it. There it is. I just want to share that with you. The median listing price hits $436,500 over the U.S. Ouch. Yuck. I shared that with clients a couple weeks ago, how we can tell that the housing market is not going to crash, right? We used all that data to show you that. But anyways, I'm sharing some of this from Realtor.com. In the blue in the background, you've got the median listing price potentially peaking. Now, what I found fascinating is if we plot the month-over-month change, look how rapidly median listing prices have fallen, which is causing this year-over-year to sort of peak out just a little bit there. Also, there are way more listings lowering their prices than raising. The ratio has gone strongly negative there. So over 20% more listings are lowering their prices than are raising their prices or keeping them the same. That's how they present the data. I should have put that there, but you got lowering prices, and you see that. Come on, you're looking around. Everybody's always looking. You see prices coming down, and that's okay. New listings. The number of new listings, what I did is you've got dark blue, should have picked a different color. Dark blue in the background, new listings fall during what is historically and a seasonally strong time period, the summertime, right? New listings tend to perk up. People need to sell their home. They get, moving before school starts and all that stuff, right? We see a little pullback there. And the pending ratio is just the number of stocks that were, the number of homes that were a listing that went pending. So in other words, the number of homes going pending from being an active listing is rapidly falling apart. Thought that'd be fun for you. And then days on the market. If you're looking to sell a home or you are currently selling a home, it's not horrible. I mean, this is well below average, but days on the market are starting to perk up, just over 40 days there. So a little patience if you happen to be selling a home or thinking about selling your home, and it doesn't go in 5 minutes, right? That's okay, right? No big deal there. New highs and lows, we won't do those today. There were 15 new highs, but a lot of them were extended and remain extended. A couple examples, Waste Management, see that there? You're going to buy that there after it's already had that big move. Grainger Worldwide, these guys are killing it. You're going to buy that after that move? I don't think so. And ADP, you ready to buy that now? So there's a lot of that, and I try not to focus on just pointing stuff out for the sake of pointing it out. Then you get excited and you want to buy it thinking I said something good. No, I'm trying to point out that new highs are suspect right now, in my opinion. Okay, where are we going? We're going to stocks in the news. And it's not ADP. Coinbase. Coinbase actually didn't fare too badly today. Revenue missed by more than 5% of expectations there. The number of transacting users, so I always try to point out what metrics each company uses, revenue per available seat mile, number of subscribers like Disney After Hours and all of that. Number of transacting users was 7% higher than expected, right? So we say, all right, you missed on revenue, but the eyeballs are still there. The number of people trading in crypto, which is what they're focused in, perfect. The number of transacting users going forward was where the negativity was. I said, we think that number is going to actually go down. I don't know. And what I found fascinating, total assets under management was $278 billion. Okay, good, very good. That's certainly much larger than us. But it fell to $96 billion. Whoa, talk about volatility. That is a great way to illustrate that crypto is volatile. You have to know what you're getting into there, because that's wild. That's more than half, right? Ooh, darn near a third, right? All right, anyways, back to the charts here. Roblox. Do you like Roblox? I brought this one up because I feel like I've seen you guys mention this a couple times. It ended up finishing positive on the day. Total bookings in the second quarter were down by about 3% more than expected. Daily active users, they use that metric as well, down about 4% more than expected. And the hours engaged on the platform, kind of like what Twitter does, was a huge miss, actually. But the stock was apparently a buy as it pulled back there. I don't know why. Just checking to see. Yeah, revenues came in stronger than expected. Maybe people were hanging on to that. I don't know. What do we got here? Tesla, I guess Elon Musk selling a bunch of more shares. I don't know why. They are doing a 3-for-1 split, and they will very likely shortly after start talking about a share buyback. But in other words, Mr. Musk won't be participating as much because he's selling off some shares, probably to fund other things. Taiwan Semiconductors. Remember the semiconductor stock saying, it's not looking good, right? We see it getting better, but it's not looking good. Intel and the like, when they reported. Taiwan Semiconductors, 50% year-over-year increase in sales, right? Woo, that was a really good earnings report for them. I don't know if you find that stuff interesting, but if you ever want to look at earnings reports and see the definition of a all-around beat, there you go. Take a look at them. You won't be disappointed. Oh, H&R Block is the last one there. This is just earnings. Earnings came in a little bit weaker than expected. They gave guidance to stay exactly the same, positive about how they're going to capitalize on the tax season, unlike how they did last tax season. It was okay. It wasn't amazing. I remember talking about that. They kept their guidance. I mentioned that. Revenues were much better than expected. You break to new highs on good news, and what's the fear, right? Think of the investor that wanted or was looking to buy this stock today. The stock broke to new highs, and there's nothing over here for them to fear. So now we have the technical analysis people saying, I have nothing to fear, sky is the limit. You have fundamentalists basically saying, I saw earnings, I have nothing to fear. that's it. Those are the two types of, there's the algorithmic traders, but that's just the day traders and stuff in there. Otherwise, you have both parties agreeing there's a good time to buy the stock. That's why you see such big moves like that. So many lessons here today, which we like to share with you. I will take your questions now and get on out of the way. Sadly, Disney, I didn't go through their whole earnings just yet, but when the number of subscribers is strong, what do? Let's just pretend you had a small streaming business, right? And you I don't know what you stream, but you stream something, and so your subscribers are going up, and you notice more and more and more of them, and you're like, this is great, let's make some more content. What do? You raise the prices, right? And that's what Disney's doing across the board. Looks like they jacked up prices across the board, right? So is that bad from a business perspective? You got more people, jack up the price. If some of them go away, you still end up making more money. You would do the same thing. Okay, what do we got here? Yeah, raise prices. Papa's got it, man. That's it. So I'll go through, that's all I really looked at. I'll go through Disney's earnings there, and we'll see what comes of it tomorrow. Ashraf, is there a way to scan for stocks that hit 52-week highs or an all-time high after hours or pre-market? If you're trading on a, Webull or Robinhood, probably not. Those are very retail platforms. Any other, I don't even know if they have a name, not institutional platforms, but somewhere between Robinhood and institutional platforms like TD Ameritrade, E-Trade, Schwab, and things like that. You absolutely can. Yeah, you just want to change your settings. If you're in Thinkorswim, by the way, you would go to the top right, change the setup to say, show me after hours data. Then when you run your scan, you would actually get after hours results. Yeah. Oh, you trying to get me to be an economist? I'm not an economist. Yeah, we actually make money. That's the joke. I'm not picking on anybody, but you would, so investors, traders, market participants, fund managers, you kind of laugh at economists because they're great at theorizing things, but they're horrible at making money. So tough one there. Oh, tell me AMC's not doing so. I don't like talking about these. All right. Yeah. I don't have a take on it. I don't get it. I'm just honest with you. I don't know why it's a buy. It's a speculative play. I don't mind that. Right? You speculate with futures or indices, whatever you want to do, but I'm not going to be able to say, oh man, AMC is killing it and opening theaters and getting lots of headline, names and bigger revenue share from the production companies. None of that's happening. So it is purely because people want to trade that particular stock for that day and nothing else. So there's no analysis to be had. There's no technical analysis, no nothing. It's just people being emotional, having a fun time during the day. Yep. Oh boy. Yeah, VIX. So the VIX futures didn't quite get there. What are you looking at? You use the ETF? No, that didn't quite get there either. They're the same number. So I don't know what I mean there. Generally, and I would say this is a good time. With the market being extended here, you double check the VIX and you go, if it's low, it's time to sell a little bit, right? If you're mid to short-term trader. And it is certainly low. And I don't think the roll comes for another couple weeks. What's the rate of change on Americans' credit use versus last year? I believe I shared that with you yesterday, maybe the day before. I'll share the charts there. Yeah. If you're you got to break it into, when you say credit, you have to break it into revolving and non-revolving. That'd be the data. So you're looking up non-revolving credit change month over month. Non-revolving is well beyond new highs, but revolving credit has yet to hit new highs pre-COVID, which we talked about. Need to put the old music back. I didn't even know I can't hear anything. So whatever, it's Cody's fault. Yeah, right? You changed the music? Oh, we had to change the music. Oh, what was did we got copyright? Oh, got copyright something or other. Yeah, we had to change it. Can we get like an old jazz song that just nobody owns, that doesn't sound like a keyboard at a circus? You love the new song? Cody says, to hell with you. He loves the new song. Yeah. I'm sorry, man. Uh, oh, man. We try to change it every now and then. Just why not? Keep it fresh. But I actually don't hear it. So whatever's going on before or after the show, I don't hear. I can't hear it. Anyways, I am going to get out of the way here. We'll be back tomorrow. Remember, tomorrow we've got the Fin Tips video. We have this class again. We'll do the closing beat, and we'll have Wine and Wealth for clients. We are, I believe, the only advisor that goes like this. We just constantly go. You don't have to come to all the classes, but if you're one of our clients, I just want you to know that I'm always here. I'm always sharing tips and tricks. If you need to catch up at other times, that's fine. But you will not find me sitting on an island laughing at clients for any reason. We work. So I appreciate all that you guys have done as far as supporting, subscribing, thumbs upping, all that good stuff. That really, really helps us out. You enjoy the rest of your day, and we'll bring the goods tomorrow. Adios.